because I've noticed the lighting is a little off. Oh, we're going live. All right. I am going to share this on the newsletter. Maybe if you guys want to tell me if you guys think that is annoying or not annoying based on if I send out this as a newsletter.
Yes.
We'll see. We'll see if it irritates people.
Like getting our email notifications for when we're going live.
All right. What do you think is Prospero.ai CEO now live on YouTube? All right, let's see. I'm just gonna say Prospero.ai live on YouTube now. I don't need to like plug myself. Everyone, allow comments from everyone. Social preview. There we go. Sorry, we are. Sorry for the delay. We're going to post this on X as well. I think that's the first time it's successfully called it X and not Twitter.
Backwards still. They say Twitter and then they correct themselves.
Well, they get both brandings now. I don't like, I've talked about this. I don't know how they pull off like on, oh wait. I don't know how they pull off. Oh no. All right, here we go. We're gonna start now. You wanna tee me off?
To another Prospero weekly live show. We're going to talk about all that's going on in the market today. Seemed like there was a lot of fear going into the weekend. I don't know if it fully came to fruition, what everybody was fearing, because the market is, as we've seen, opened up today. So it seems like it's kind of a rebound day so far. But if you want to give us your most recent stance on the market, George, and we'll go from there.
Yeah, we definitely need to make sure that it's been teasing up one direction and then going in the other direction a lot. So we should definitely make sure the rest of the day be careful. That's why I was going to say we should keep our eye out on it. And what I'm seeing right now in terms of like the technical side, I'm just pulling it up. It looks pretty solid. Like from my standpoint, it's losing a little like it's losing a little momentum on some of like the larger charts that I'm looking at. But it's kind of looking a lot more bullish than bearish from the technical side. Now, if you look at our metrics, basically what we're dealing with here is SPY and option sentiment like fell to the floor at the end of last week, which generally is a pretty bearish sign, as did QQQ, net option sentiment. Not to like the floor for where it is, but it actually fell below 20, which is very low for QQQ net option sentiment, but not as like concerning for tech necessarily if SPY is going lower than QQQ net option sentiment. But they're both recovering a little bit today. I saw them coming back, and I'll take a live look now just so we have exactly up-to-date numbers. Yeah, QQQ is sitting at 27 after opening at 21. So net option sentiment, and SPY is at 13 after opening at 11. So there's some positive momentum up, but at the same time, it is not necessarily it's not necessarily looking like I'm too excited based on this price movement and, a very solid start, not necessarily being that well reflected in a big adjustment in options bets, some adjustments, but without QQQ kind of going to the bull level of 30. I'm much more tentative than if it opened up and then shot up to 40 or something. That would tell me that would make me a lot more bullish than I am right now. This behavior, I'm concerned for the afternoon, unless we can kind of clear those levels even higher, I would say.
specifically is like kind of in the beginning of the year, you made a clear distinction between tech and non-tech stocks. And then it seemed like as the market was going down, you kind of maybe favored safer plays and like less technology more. But is that still continuing for the rest of the year, or are you seeing as we're starting to get like these bullish signals like back into tech or just the market in general?
Yeah, I think we're talking about it. Like I think as I've talked about, I'm definitely hearing some whispers that AI, the impact of a lot of computing resources and things like that, like cloud around AI, like that is expected to come in very solid and maybe even beat estimates. So I think that's where we saw like 2 weeks ago, as I was starting to hear whispers of that as a reason that tech had a better week than the S&P and a pretty decisively better week than the SPY 2 weeks ago. Last week, SPY was a little better than QQQ, but not really anything to write home about. It was up like 0.46 versus 0.14 for QQQ. But I do think that's kind of what we're looking at, where it's just like, I think after, either we get to earnings and tech does impress, beat estimates, especially on things like cloud and chips, would be the main things that I'm looking for to like see the tech boon. But then I expect it to tick up, and then maybe around interest rate fears, inflation fears, losing that momentum very like quickly to end the year. That's like the better case scenario for tech. The other side, I think, is it might not come in as well as some people are anticipating on things like cloud chips in terms of the earnings. And then I think the concern starts to be a lot more that could be a really bad end to the year for tech if they disappoint on, I would say, those like kind of AI business growing markers. So that would kind of be my concern. I definitely think SPY stocks. We've seen some, obviously better with energy stocks. We've actually seen a lot of resilience from real estate, even though it's having, I've seen it have some, bad days, bad weeks. Those are things that I think could ultimately carry the SPY pretty well. I mean, obviously, we're targeting in our shorts consumer cyclical stocks, and we've done pretty well. I mean, we've done pretty amazingly, even more so in our model portfolio recently. Around, I would say, especially targeting a consumer cyclical. But actually, if you look on, we just released our 9 months results. We did very well, 83% in excess of the S&P 500, hitting on about 64% of our picks in terms of a win rate above their SPY benchmarks. And actually, like I've been doing more like retrospective analysis as I've had more time. And my retrospective analysis actually has been telling me that apparently the industries that I did best most consistently with were healthcare and financial services. And it's kind of funny because in my mind, I thought I might not have been doing as well because I've been burned like a few times. But the majority, I had a 77% win rate on financial services and 76% on healthcare. So those ones, when we're seeing certain patterns in the metrics that put us in the newsletter, and that generally is like bad trends in net option sentiment is first and foremost what we look for in terms of also like raw numbers on low profitability, low upside breakout, high downside breakout, and increasingly we're looking for high dark pool rating. So typically above 60, that's where we see the pattern, especially in the short term of stocks doing well. And it might actually be worth. I haven't like talked about this live with the numbers, and I know I don't typically share a screen in this letter. I mean, in this live stream, but I do actually think it's worth just talking about that. We were going to do a short with this, but it hasn't materialized. Someone that was making the video, it is a complicated topic, so maybe it's just best for me to do, and I will share pretty quickly because I do think this is a very important thing to look at. And I know we just had some of our letter readers join as the warning went out that we were live. So the thing that I've actually found very interesting about is this? No, this is not the right letter. Sorry for that. It is. I saw this picture and I was like, oh, that's right, but it's this letter. This is the particularly interesting thing that I'm talking about. And in one of the letters, we mentioned kind of this pattern where we actually noticed that in the 60 to 80 range of short pressure, and you can see it here too, there's actually lower performance for those than the max short pressure because, we see short squeezes, we see retail kind of piling into those huge short pressure stocks. And here is when we started using dark pool because we noticed above 60, there is a pretty reliable metric here that dark pool and 1-3, anything in kind of like the short term where you're holding for a little bit, those higher dark pool stocks are doing worse or better for shorts. But what's interesting, and this is for people that do short squeezes or look for short plays, what is super interesting is, and for those that don't know what the dark pool is, that's where institutions transact privately with each other in a way that retail doesn't have access to. And often it's different than what the market price is. And yeah, so you can see right here that you can mess around with the price on the dark pool, but eventually, you go 1 day, 1 week, 1 month, 3 months. That's, people with high, like stocks with higher dark pools are going down. But by the time you get to 6 months, you actually see some of the effect of the market price catching up to those stocks. So dark pool, that's why we start looking at it as a short-term metric and why we're often filtering by it in addition to short pressure. But why we don't do above 70 short pressure on our longs and our shorts is you can actually see that, yes, there is some inconsistent data. When you look at 1 month and 3 months here, you actually have better, you have some clear, advantages, especially in the 1 month, shorting at the 60 to 80 level. And then obviously the really interesting thing here is, unlike dark pool, it looks like high short pressure stocks, for the most part, eventually start losing. But that's not the case. It's the opposite with dark pool. So that is some really interesting things to take away. The other thing, just like while we're here, before we go back to our regularly scheduled programming, while we're here, the other thing that we looked at is that like high growth stocks in this market actually are pretty universally bad. But one of the things we really saw, and this is why we talk about profitability plus growth often, if you get a nice combo, even if it's like, say, 80 growth and 40 profitability, getting in this 120 to 160 range, you actually see a much more reliable, kind of pattern. So that's why we talk about controlling for risk with profitability and growth. I will pause for questions here before I stop. I don't normally screen share here, but I was like, this is really good information. And I noticed a lot of people joined from our letter. All right, on to the regularly scheduled program.
Okay, so I wanted to ask you about a quote that I missed that happened on Friday. Jamie Dimon, whose words weigh large on the market, had a pretty, I would say, gloom and doom quote. Let me read it right now for you. Jamie Dimon, this may be the most dangerous time the world has seen in decades, which cannot mean good news for the stock market. And what do you make of him saying that?
Oh, you mean my future coworker, Jamie Dimon? No, I'm joking. I'm speaking at the same conference as him and Ray Dalio on December 3rd. So I'm very excited about that. But yes, I mean, I think, Jamie Dimon tends to be like all of these CEOs of banks have more, they have their own personalities. I would say Jamie talks a lot more than the other ones. You rarely will hear someone like David Solomon at Goldman kind of have his comments on the market. Not as often, but and so Jamie talks a lot. He tends to be more conservative. That's understandable. There's a lot of people that just have like a base level of bearishness. It's one of those things that we talk about in terms of having the right investing approach and investing philosophy. And for me, that's always like watching my back, assuming I'm missing something. And I think, if I see one thing more wrong with retail traders than everything, it's how overconfident they get. Sometimes after like 1 or 2 wins or even just, not great performance, they're still really confident that they have it right on this particular occasion. And I think that that's the biggest thing. And, something that I very much agree with him on is it's best to be adequately afraid of the risks and kind of make sure that you're having the proper respect for the market in that thing, especially, you have to be a base level of bearish right now because we don't know what's going to happen with inflation. There was a bit of a concerning reading we don't know what's going to happen with interest rates as a result of that. And those are huge markers. So even if you think you know everything about, say, NVIDIA, and you're saying, well, I know there's going to be like more chips, blah, 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 whatever. Like they did amazingly in their last report. But again, it's all about the market and the value. So like they could do just as amazingly, and there could be very, very bearish news on interest rates, and the stock could go down with another amazing quarter just because like they are already trading at such a high multiple. Stocks with huge multiples, and we saw it last time. That's one of the ways Nvidia became so undervalued. But stocks trading at a high multiple, and I think like last I checked, it was like a 60 x 2024 PE. And like you compare that to like Meta and Google, which are about a third of that, which are both below 20 on their 2024 PE, which both have good AI exposure too. And Meta, everyone's even in that category talking about making their own chips. So there's chip upside, or cost savings is a better way to look at it for those people. But yeah, I think that is something that is really, really important that people remember, that no matter how good of a grasp you think you might have on a particular stock or the forecast or whatever, like macro concerns can totally crush that thesis, and why you always have to like keep your eye on that. And that's why, I think the good advice to take from Jamie Dimon there, that it could be a very scary time. It's a very uncertain time, and you just have to make sure you're like properly hedging your risk. Even though by the same token, like we're saying, it's a very exciting time for AI. A place like NVIDIA could really beat earnings again, really beat revenue growths and have some massive growth. So I think the takeaway is like, yes, watch your back, make sure you're taking the proper risk management into account. But there are some potentially exciting earning events coming up. Especially as it relates to AI, cloud, the kinds of things that we've been talking about to start off the stream. But yes, I think it's always good to remember, and it's always good to heed the words of smart finance people. And one other thing on that note that I wanted to add, which is that just that, like, I see retail investors all the time saying like, oh, like the news lies, I'm not going to read the news, or I'm not going to blah, blah, and they just like totally disregard information. And you'll never be a better investor if you have that kind of attitude. What you need to be able to do is take things in and be skeptical about it, but still take in the information. You could be like, oh, like Jamie Dimon is just, he's short the market and he's saying that. Like that could be your skeptic's take, right? But even in the skeptic's take, you have to say, oh, well, maybe JP Morgan is super short the market, and that's going to work. So that's like the skeptic's take on that, where it's just like, oh yeah, he could be trying to control information. He could be trying to control my view and my mind. That is very well like a good skeptic's take. However, he could be trying to do that, and as we're talking about, be right about that. So you have to be able to take that in, decide if it's like, pure manipulation, or it's something that could be at least sort of useful to you. And that is an area that I think a lot of retail investors could grow in.
Get into the next topic. It's funny you brought up some upcoming earnings, which we're going to talk about. I just have to compliment you on that shirt. It's phenomenal. You're totally outdoing me today, so we'll just mention that in there. But I wanted to bring up.
I'll get you a shirt as a present on our 1 year anniversary of this stream, Stephen.
I'm gonna hold you to it. All right, but okay. So you brought up some earnings, and we have probably the favorite stock among our watchers, Tesla, this Wednesday after hours. Elon Musk said on every earnings call going forward, but hopefully he's on this one because it'd be good to hear how he's seeing things going forward. Do you have any expectations for their earnings this quarter?
Ooh, I am a little concerned about their earnings. Like we'll see this week. This week is going to be very telling, because I would say the typical behavior I've seen from Tesla is like, and everybody gets these earnings whispers on the street, and I have like, to tell my story of like actually someone that I'm pretty close with who used to work at Steve Cohen's hedge fund. But basically, like there's things that go on that are like not actually illegal. Like you can go play golf with someone and ask the CEO of a company, like, hey, how do you think you're going to do in earnings this quarter, whatever, this year? And they can give you a look that you're interpreting, and the information. We could all read verbal cues, but verbal information, not verbal, non-public information is legal. And yeah, there's some gray area that maybe if someone was witnessing that, they would say, oh, there's information exchange. But the chances of them actually like winning a suit with that, we could be like, what are you talking about? I just made a face. Like, it's a pretty frivolous waste of time to get someone like that. So when we're talking about like how do people understand earnings, and even me as a buy side analyst, I started when I was 17. I worked at a pretty more serious like value fund, a larger one, two summers after, and I would get access to CEOs sometimes, at least CFOs or the head of investor relations. And the thing about that is like even as like a smart person that knew the business, I could answer questions, and by their tone, by getting to know them a little bit, I could have a view on how they were going to do on earnings that I just don't, as a current retail investor, just like the rest of you, that I don't get that same information. Now I do have sources that a lot of you don't. Growing up in New York, will do that, and being on Wall Street from a young age, and I obviously incorporate that into my views and when I pass along to you guys. But I would also say that based on that, I typically see Tesla going up before earnings. Just because I think the whispers, what people think, like, are going to be good reports. I have yet to see that heading into this one, so that concerns me. By the way, not enough to short Tesla. Like, there's a long list of stocks, like Nvidia, we mentioned them. Nvidia is not a stock I would go short or long for the foreseeable future. It's depending on so much growth in its price, and it could hit that, it could not hit that, and either way, that's a big, like, binary event. So that's why I wouldn't touch something like that. And Tesla right now is looking similar like that. And that's a temporary situation. Nvidia is like a permanent embargo until they're going to stop growing at like 100%. Like, that's in terms of top line revenue growth. That's really, really hard to keep up. But if you do, and there's not necessarily a reason to think they won't, it's just a very aggressive target. Hard to bet one way or the other on that. And I'm feeling like that with Tesla. We see that they're lowering their prices. Like, that's, Wall Street forecasts on margins. So their margins are hurt. However, some of that price movement can be helping their sales forecast. We could already see an impact in markets where they've adjusted their price on sales. So it's one of those things that's very, very hard to forecast. But I will say, if I'm leaning one way for this earnings, bullish versus bearish, I would say more bearish based on the price action I've seen. But I actually just want to check how net option sentiment is doing for Tesla, because I can check it pretty easily here. Yeah, it's at 100, which is not atypical for it. It did touch 87 on October 5th. So, and it went as low as 94 last week. Not really that low, but I like to see, if I'm bullish on Tesla, I really don't like to see it go below 90. So even that it happened in the last 2 weeks, that is like, for most stocks in net option sentiment, that would be amazing. But Tesla typically runs higher than any other stock in net option sentiment pretty universally. It's the example that we use when we say that net option sentiment is a bit nuanced, because that will always run higher. We have, finance stocks will always run a little lower, because for people that don't know, people don't want to own options as much as that, because they don't grow as fast. They're kind of like more entrenched, more lumbering, more about profitability. And any stock that gives dividends, you would much rather own the raw collateral that pays out the dividends than the options that, like, yeah, you could exercise, but then you don't own the option anymore. And exercising options early is just not really the best way to use them. So yes, I think that we definitely are in a place that I have concern for Tesla. But that being said, keep watching it. If net option sentiment stays high, if we start to see some like price resilience, and I would say price resilience of that moving versus like other tech peers, if you start to see Tesla moving better than stocks like Meta, Nvidia, the other big seven, basically, if you see it moving up proportionally better to them this week, and we'll check in on that in our Wednesday stream, then you might say, oh, maybe we start to have some of those earnings buys. Because what you can also see in these kinds of situations is a stock being heavily shorted because they're trying to get a better price before a good earnings report. So it can go either way. But we'll investigate it. And yes, we see you, blockchain monkeys. Thank you. I've noticed some comments. I'm very excited about your enthusiasm for the project. Email me, George at Prospero.ai, and we can talk about that. Steven actually helps with that, so you might end up talking to him, but we can have a little conversation about it first. But yes, I appreciate the enthusiasm.
For Tesla, since they're a company that they're I guess not on Nvidia's level, but they have a lot of future growth priced in their stock. If they this quarter where they had like negative or like underperforming earnings, but they made a big announcement like, oh, self-driving is actually going to be released, or the Optimus robot is like coming next year. Could you see, is this in an environment where they could still go up based on news of the future, or do you think they need to produce on earnings?
I think that is exactly why I'm cautious with companies like that, and why I say like I wouldn't go short Tesla, even if I'm like leaning much more that there's gonna be some disappointment, because you make a really good point where it's just like we actually don't really know. Like we don't really know. It's very hard to tell. And often a company that's like, damn, we have some really disappointing earnings on the way. Like they will think of an announcement like that to make sure their stock isn't getting, or not think of. Time is probably a better way to say. Like, yeah, like should we make this announcement? We might get killed if we don't. So yes, companies are thinking about that kind of stuff all the time, and it's very important to them to really have a handle. And we talk about this, like to manage their stock price, like manage it actively in terms of the information that they're sharing, how much they're sharing, the timing of that. They're always thinking about that. They're always having those conversations. So yeah, I wouldn't be surprised. And that's where you really get into the nuance of what we're talking about. Like, yes, can you play golf with Elon Musk and get a feel for how Tesla's earnings are going to come in? Probably. Like probably if you have a large enough, like if you're a large enough investor, he's going to take the time to like spend some time with you, and you're going to glean stuff that other people don't. Like, or as we've talked about in the case of Warren Buffett, like help run the company. Like you have that meeting with the CEO where you're a major shareholder and you give them advice, and they probably take it because like you're probably smarter in terms of running a business than most CEOs, and B, they don't want to piss you off. So they have both of those incentives to listen to you. But on the other side, like no matter how, like unless you're like actually really good friends with Elon Musk and they have a big Tesla bot announcement, like you're probably not going to get that information out of him. And you're probably not going to get that information out of anyone, because that is actually where you can get in the most trouble. If they find one leaked email, if they know there's a leak, like, that's something where like Elon Musk doesn't want that getting leaked. He wants to be the one that makes that announcement. Or he wants to control the flow of that information announcement. So yeah, if that gets leaked, he's probably conducting his own investigation on like whether that has happened. So yeah, I think that we very well could see like an exciting announcement like that, especially like I might even be concerned if at the top of the investor conference call there's a big announcement about the Tesla bot or something that's just like out of the blue about like a later forecast. I would then be like, oh, buckle up. We're about to whoa, my phone almost fell. We're about to have a bad earnings call here, because he led with that and he's just like trying to manage that. We have an answer on digital assets. We don't own or cover them. I mean, I did my diligence on them a variety of times, and pretty much the biggest reason is, for those that don't know, a lot of like our three, what we call our hero metrics: upside breakout, downside breakout, and of course the best, net option sentiment. That is derived from the options markets. And crypto actually has non-transparent options markets. You can see where leverage is being traded. You can see where there are options, but it's incomplete information. And I actually asked like the largest crypto hedge fund at a Google event if they knew all of the lever transactions, and they said no. a representative from their company said no. That wasn't their official statement. So that is to say that we don't like to play in markets that we don't like have a really good handle on predicting. And part of it is I and my team have to be able to wrap our heads around a logical way that we can say these predictions are effective. And these equity predictions I've worked on for almost 10 years, the algorithms that underlie these formulas. And I've improved upon them. And the big thing is making them more explainable has also really helped. But you look at crypto on the other side, and we were recommending some crypto miners a few years ago because, those were going off like gangbusters and there was a lot of momentum behind them. So I, like a good value investor, did my deep dive. I mined, I tried to transfer, I did a lot of different stuff, and it just didn't stack up for me. It wasn't developed enough, especially like I'm a decent coder and I would say really good with computers. And like even that, figuring out how to like transfer, not getting hit with gas fees, it's just like it's not there yet, in my opinion, in terms of being able to be like a mass market thing. And the whole big thing with digital assets is like they say that it's like about transparency and about fairness. But if you don't have derivatives transparency, that is the worst. It's not real because like you don't know, like you see a major wallet buying or a major wallet moving off. You don't know if they're 10x levered the other direction and they just want you to buy call options that they can then burn by shorting the stock later and like having those call options die or their put options cash in. So yeah, I think that's a big problem. So there's the problem of like me thinking that non-transparency is not fair. And like you can say what you want about Wall Street, but there is a single clearinghouse for all levered transactions, and you can see there's an official open interest number that's published by that clearinghouse every night. So that's more transparency, a lot more, in my opinion. And we have to build predictions that I think work. My big problem with almost every other AI company that isn't us is they're promising these magical nonlinear equations that can, beat the market, this or that. And it's just like, how? That doesn't make any sense. You cannot compete with Bridgewater or Renaissance or whatever in a nonlinear equation competition. And for the first part of my career in AI, I tried. We have joint IP with NYU. We built advanced technologies like evolving neural networks that use evolutionary algorithms for like a fitness selection process for the algorithms to improve and like live and die based on how well they solve a problem. That's pretty much as advanced as you can get, especially when we did it. And you don't really have hope to beat those people in a nonlinear equation competition. A lot of them have a 30-year head start or maybe more. A lot of them have, what I said in an example to the conference I'm speaking at is like, a lot of these startups haven't even raised $100 million total. Like Renaissance wouldn't even notice losing $100 million in a day. That wouldn't like flag their compliance or anything. That's the different scale of resources that a startup claiming it could beat the market and us. So what's different about us? We actually have an approach where we're tracking these institutions, tracking, visualizing the options bets. So to me, that was something that made sense, especially as it started to work and we honed our formulas and we honed our process about how to follow them. And what's very interesting along the way that we found out, and this is something that, we learned and I think rewarded for what I would say not being greedy, is the other thing that hurts most strategies is like they'll work when they're smaller and they have less assets. But the more assets you put behind something, the easier it is to reverse engineer what you're doing, the more interesting it is for other Wall Street firms to start being on the other side of your trades. And that's what most people don't necessarily understand. The real game on Wall Street is not returns. The real game on Wall Street is marketing for dollars. Returns are a part of that story. But the fund that makes the most isn't necessarily getting the most dollars every year. It doesn't work like that necessarily. It is about your story. It is about the way you present, pedigree, approach, how much you differentiate your approach, all of those things. But a big part of that is also just raising those dollars and how you raise those dollars. And the more dollars you have behind your strategy, the more interesting it is for other people to start attacking you. So even if strategy is doing well, there is a timer on it. And that expiration date speeds up the faster and more money you put behind it. So a big problem with these like nonlinear equation startups is like actually the better they do, the sooner they're going to basically start losing money. And the problem is when you're totally dependent on a nonlinear equation, and we went through this in our journey, like we're just like, well, the equation's not working anymore. And then you're starting from day one and you might have you might be investing a bunch of other people's money at that point and you have no idea how to fix it. That's why we switched much more to our approach now, where we're more focused on visualizing the bets, visualizing options bets in real time. So we're giving people a scale of how well or bad Wall Street is viewing those stocks in the options markets in real time. And I think that that is a big difference and why we need the options markets. Because to circle back to crypto, like if we don't have a good view of how the options markets are doing, and basically it's a non-starter if people, like even the experts in crypto are like, we don't know what the leverage is. That makes it a non-starter for me if they don't even know that. And that battle is too far uphill for me. But even if that wasn't the case, we would still need these really good option numbers and solid and flow and everything like that to even start predicting something. We have to have a reason to think that we can win to even engage in that behavior.
Worked up on crypto. I hope you got your answer. There was a lot of information in there. And actually, a question I have from that soliloquy you went on is, and like how long AI has been around and you have like an extensive history in it. So what inning would you say we are in like the scope of AI development from like nothing to where it's going to be everything that we see?
Oh, probably only like the fourth inning, maybe the third. Like we've talked about this, and obviously, like I think we've talked about the differences between us. Like it is currently being integrated into our lives, but it's gonna shift. Like actually, quite literally, I was using this like from us being in the driver's seat to it being in the driver's seat, and I was like, oh, that's literally what's gonna happen with cars. So we're gonna like be able to see that transition live, and it's already started, obviously, with some of the cars literally being in the driver's seat. But I think that's the way to think about it, where you're just like, okay, even look at the way people interact with Chat GPT, right? Now it's like you having Chat GPT help you solve problems. But sooner or later, like Chat GPT or whatever the next generation of these things are going to start to learn your problems and have their own ideas to solve. And then all of a sudden, who's in charge if it's doing your job? And that's going to happen, more and more. And I think that's why we really focus on like metrics and signals and using AI to form better ones for people, because it is my personal philosophy that people should be empowered by AI. And it gets more and more dangerous the more it's just like taken over. And granted, long term, we will have our own version of automated investing. And the way we want to do it is we're actually going to have a high yield savings account. So something like a 9% a year savings account. And the reason that we like a savings account is I don't necessarily think it's best for retail investors to have choppy returns, like up 20% one year, down 2% another. And those are like hedge fund like returns. But if you can give retail investors like a 9% return a year, that is, I think, a much more responsible way to just promise something like an institution might get, a stable, high interest return. So we want to do that. And basically, we will be able to do that because longer term, we're going to start to partner with retail investors to gather alternative data that we can benefit from. And the best example is like longer term, we might ask a question like, what's your temperature? And be able to model a pandemic in real time and essentially do what the state senators did when they were looking at hospital data, reassuring the public and making money shorting the market. Instead of them having the information arbitrage, we would collect value information from users and deliver that information to them in forms that they can use it. And I think that like we are seeing more and more of that kind of thing get into the market. Because like right now, hedge funds just take that information from people and they use it for themselves. So like that, when we do go automated, that's that's the way that we want to do it. But our learning resources will always be there, and that's important. Like AI, I think philosophically should not take people away from the decision points. It should support them. It should empower them to make better decisions.
Number, is that like a real goal for you, or is that just a random number that you just said?
Could be higher, but it's 9% because things are pretty high really now, and that's how we might look at it, doing like substantially higher than like where it is. Like it might not be 9% if the competing rate is at like 1%, but we're trying to beat significantly other accounts.
Sidetrack there, so I'm gonna move us on to our next topic. But I think there was a lot of good stuff in there, and a couple good quotes that you guys will probably see if you watch us on Instagram, TikTok, in short form this week. Look out for those. So, Rite Aid, which filed for bankruptcy, which is kind of sad for me because there was like a Rite Aid right next to my house growing up, and I don't know. You see these businesses in person, and you're just like, oh, they're a nice company, and then in the inside of it, it's just a dumpster fire. But and you've been calling out retail for a while about how you don't like them, so I just thought I'd bring this up for you to kind of talk about that point you've been making.
Yeah, and it's actually an interesting point about like my evolution, especially in the model portfolio of the signals. Because I actually took like a 50% loss shorting Rite Aid, and then I also made about like a 25% gain, but I didn't hold on long enough because it obviously went further down. And like that's just like we're talking about like owning your thesis and everything, but especially like these like heavily shorted like retail and I say retail investors, a lot of people were interested in Rite Aid. So that is, it's very hard and even hard for me to look at it and be like, oh, like downside breakout is really high. Like it was like close to max for a little bit and option sentiment is low. But like even then, like I'm looking at it and I'm looking at basically the price going up, but the metrics staying down and trying to figure out what I want to do. And like at one point I was just like, no, a 50% loss is too much. I'm getting out because I don't want to get like I don't want to get like a 500% loss or whatever, like, which is the risk. If like, say their price goes up, they get like, they do a new equity issuance because the price is going up. Like we basically saw with AMC, and that like basically gives them more life and gets them out of bankruptcy. So like you're dealing with that. And it's very tough to look at these. It's very, very tough to look at these stocks, and why I generally suggest like retail should stay away from them because like Prospero was right. And I try to just like go with the signals as much as possible. And it hated this stock for a long time. It hated right. But like even with the metrics hating it, like I basically saw the loss in my model portfolio like ramping up. And I didn't trust the signals enough. I was like, no, this is too much for me. I got to get out. But I think that is like I think that is a big part of it, basically. That, we don't necessarily know. Like, I don't even necessarily know how to deal with that and how to like say like, oh, well, retail has like enough momentum that they can keep carrying this, or the shorts are going to eventually win. I think that is close to an impossible assessment to make. So people should really watch it with them. Or like on the other hand, like I have half of mine that, or I have the other half just be like, look, I should just like set it and forget it on these. Like Prospero is eventually going to be right. If there's that many people betting against something like Rite Aid in the long-term options markets, especially, these people have to know something. This is what it was built for. So I'm really of two minds on that. And it's tough, but like, to the other thing that you said, really tough time for retail now. And they had like some legal issues on top of that. And when I say retail, I mean like retail oriented stocks, consumer cyclical stocks, we might call them, so we don't necessarily confuse retail investors and retail products. But yeah, very concerning. It's going to be a tough time. I wouldn't have a whole lot of them in my long portfolio. But yeah, it's an interesting evolution of the Prospero signals. And for those that don't know, we have a free 1-week trial on our trading letter at the top of our letter this week, and you're going to get to see like a lot of the analysis. And that's one of the things that I'm going to go through, a longer form analysis of these types of things, like when to trust the signals, even if the price is moving in the other direction, how to approach that. Because as I'm saying, my thinking isn't even done with that. That's a live like process that I'm figuring out what the best way to capture value in a stock that, institutions are decidedly pricing to say go to bankruptcy, yet the market price isn't reflecting that. And my investment is taking a little bit of a beating because of that. That's a very hard. And what an institution would say about that is we don't care. Like, we don't care that retail's doing this. Like, we're going to keep shorting this stock and we're going to win. That's what they'd say. They're like, there's no business to it. It's only a matter of time. Like, we're going to keep this price in control. But that's what's different about me and an institution. An institution can say, and by the way, a lot of them that I know will start shorting a stock. No retail investors are going to buy it when they see like borrow rate go up, short interest, like percent go up. And they're actually, as they're shorting it, buying call options. Then having those call options like greatly increase in value, and then using the capital that they made for that call, like those call options, to make sure their original shorts are profitable. And they just like short it to kingdom come. So that's a difference between me and an institution, where it's just like, if they're sitting there with profits on call options, an imminent bankruptcy that they are fairly sure is happening, and that the stock is not going to be able to like get high enough that they'll raise equity capital. But an institution sitting in their seat can say, I know it's not going to get there because I'm going to put $1 billion into shorting this. That is not a level of confidence that I can match or you can match. So we have to have a different approach than that.
I hope they figure it out. Hopefully, they don't go completely underwater, but we'll see how it plays out. Next stock we want to talk about, Lululemon. They are joining the S&P 500 this Wednesday, and their stock was popping a bit this morning off the news. They're going to be replacing Activision Blizzard, which I think is finally sealing the deal on their Microsoft buyout. And I think I'm worried about Lululemon, huh? They seem to have a lot of things going for them nowadays.
Yeah, well, first I've got to say, like, obviously the Microsoft budget for political influence is, it continues to pay off. We talked about that Azure contract that they got that nobody thought that they were going to get. Everybody was like, well, they must have like pulled some strings here. And yeah, like the way that acquisition went, it was just like, it's happening, it's not happening, it's happening, it's not happening. It's just like so funny. It's like a lot of companies that didn't depend on political influence as much as that would probably just be like, oh, they said no. But they're just like, no, we got to force this through. Like, it's just pretty funny how much that Microsoft depends on, how much they depend on acquisitions. And like some people like I guess take issue with me liking like Google better than Microsoft. And yes, like you can have the position that all corporations are shitty. Like, yeah, like you could easily have that position. I'm not going to argue with you. I don't know one that's like really doing like an upstanding job in the world. Like at best, they're giving like 2% of their profits to like build, like to like pay people to make shoes in Africa. That's a great thing. Like it's better than not doing that, but it doesn't mean you can like, be Monsanto and literally like systematically poison people over many years and then give some money to charity. It's like, doesn't work like that. Or like the Sacklers, like, which thank God at least they stopped like getting to, like, we all stopped pretending they were good people. That was nice. But at the same time, I think that there is a difference in like what I said about the difference between like Microsoft and Google is like Google actually does occasionally invent something new, and they do have a scientific mindset. And Microsoft, like, I don't know, like Windows was their major, like, and we talk about Xbox, but even then they didn't invent something new. They just made a more American like system. I can't remember that when they actually meant something new. And the thing that I talk about with Google to like, with some of the people that I was like talking back to who think that I like just like Google more than Microsoft, which is just like, no, I respect them more. Like, I don't like any of these companies. Like, I respect Google more because they actually, to manage their search process, they invented the modern database, the modern distributed database. They called it Dremel. And basically it made calculations way faster than anything else the world has ever seen. And I remember the day that I switched over, it probably increased our database operation speed by like 5,000%. I thought it was fake the first day I used it. It was crazy. But the way that Dremel works, and this is the way it all works, is like instead of just using like one processor to just like go down the line and make changes to something, like you could have like a 1 billion row data set and it sends it out to, a million different processors to do and then recombine. And they invented that to help manage the data load for search. And then Amazon copied it, Azure, Microsoft copied it. Surprise, surprise. So yeah, that's why I respect Google more. They actually have real inventions every once in a while, and I respect that. But off the tangent, back to Lululemon, which I will say what I find is very funny is their theft policy for anyone that doesn't look it up. Lululemon allows theft. Or they say, you don't stop someone from stealing, which pretty much just means, hey, if you want to go steal from Lululemon, it seems like they're all right with that. Which just seems like a very weird, at least get a security guard. I don't know. That's strange. Anyway, as a stock, it's looking pretty good. We see a good trend in net option sentiment, higher upside breakout than downside breakout. I think if you make momentum plays, doesn't look like a bad play, even as much as we hate consumer cyclical and stuff like that. We might be seeing some good earnings coming up based on the trend that we're seeing in net option sentiment and the matching trend in price along with that net option sentiment. But at the same time, it's not my favorite play because I'm worried about consumer cyclical stocks. I'm worried about just like people having less spending money, credit crisis, blah, 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 all that stuff.
Bring up, because I know your whole macro stance about concerns in the economy, consumer credit, and all this type of stuff. And I was reading a story about how they're expecting that Halloween candy this year, $3.6 billion is going to be spent, and last year was $3.1 billion. So I'm wondering, is that a good sign for the economy, or is that just due to inflation that number is so much higher?
Oh man, that's really funny. What is like the difference? You said 3.1 and 3.6. I'm seeing
that's
like what? Yeah, I'm looking at that. 16%. That's outpacing inflation. So yeah, not purely inflation, but who knows? I think that like I always think it's funny when people like try to do those kinds of things. Oh, that's a funny question, John. Sorry, I got a little. But yeah, I think that I lost my train of thought when I was like chuckling at that shirt comment. What was the question again?
Increase. Oh wait, let me do this. Is the price 3.6 billion from 3.1
Oh yeah. Oh
inflation
yeah, I
or
remember what I
economy?
was saying. Yeah, it's just basically like I think it's really funny when people try to take like a little trend like that and create like a macro thought about it. Like I don't know, could it mean could a slight increase in Halloween candy that's outpacing inflation mean that we're in a healthier economy than we thought? It could. Like, do I want to make that leap? Am I ready to like make macro forecasts based on some Halloween candy sales? No. And to be frank, I don't think anyone should. But it might be interesting. Might be a good time to buy like CVS with Rite Aid going under and like more people turning to them for candy sales. Like that's probably what I would do with that information. I would look at like Walgreens and like CVS and Prospero, and maybe I'll just do that right now. Let's see if any of them look any good. Let's see. All right, CVS is not looking great. Although better, like much better than Rite Aid. It's got 71 net option sentiment. If you want to do this play, I'm gonna look at Walgreens. What is Walgreens symbol? Anyone know? Anyone in the there's a Walgreens Boots Alliance. What the hell is that? All right, we'll see if anyone calls out the Walgreens ticker around here. While I answer the shirt, there's actually a funny story about this shirt, which is I stock a lot of clothes on Poshmark. That I like. I think it's like a good way to get like nice fashions at a discounted price. And this is a Versace shirt that I was like watching for a long time. And maybe I will launch my own fashion line. I do have a very distinct fashion aesthetic, which I encourage everyone to have. Even if like you're more muted than me, I like very colorful things. But everybody should have their own style. It's like you're wasting your life if you don't feel like you have your own real distinct style. But so yeah, I might have a fashion line later. But anyway, no, like Steven, you'll like the rest of the story. I bought myself this shirt because I actually, the last quarter of last year, I actually put Prospero funds into like putting our money where our mouth was on stock investments, and it was up. Portfolio was up more than 50% in the last quarter of last year. So for those that don't know, I have some investors in the company who, if I was wrong and lost company funds on that, and by the way, for the people that think I might get illegal, I loaned myself the money and then I paid it back. So it's not officially, but it is like even going on online even more that way. And if I lost the company funds, that would have been a pretty bad situation for me to have to explain that happened and why that happened. But it went the other way, and there were some stressful days where I had some big swings. I mainly was just playing the QQQ and getting it right a lot of the times. But after that stressful year and coming out on the other side, I treated myself to this shirt, which normally is not a work shirt. It's normally just a fun shirt. A lot of my shirts can go either way, but I was just wearing this to a work event this weekend, and I'm probably going to have it dry cleaned. So it's going to get a live stream appearance before that happens.
Actually do have a funny question based off that, because you see guys like Mark Zuckerberg and Steve Jobs wear the same outfit every day. They have like a uniform, just black shirt and whatever. So you don't subscribe to that philosophy where like they make it simple so they could concentrate on their business or whatever.
I do see that. I'm like, I am spending like maybe 5 minutes thinking about what shirt I'm going to wear to these and making the calculation of like what shirts I've already worn on the live streams and trying to wear something new. So that is something, that does take up brain power, but like, I'd much rather like have a style than not. Like I said, I think that's a real waste of like, if you're like prioritizing your business that much that you can't even have like a fashion sense as a result of it, you're like not giving yourself a real life, in my opinion. And like I'm very dedicated to my job. It's very important to me. But like if anybody tries to tell me like that I don't deserve to have like my own life, like because I have like responsibilities, I could probably tell them to go fuck themselves.
Be the cool billionaire one day, not he's going to be the Elon Musk version, the funner version than the Mark Zuckerberg end of things,
Well,
right?
actually, one of the things that I've thought about that I think like where like a lot of them go wrong is like I have not been paid in 12 years, and I want to enjoy some nice stuff on the other side of that. I want my back pay, and I want like my risk back pay, like my hazard pay, basically. But like let's say I'm buying a nice apartment in New York with those spoils. I'm going to have like Prospero users over, cook them dinner, that kind of thing. Like actually share the wealth, literally. And like I think that is something that like I think if billionaires today just made a little effort to look like they cared about other people, not really, and I do actually care about people. But like, and I'm not like that's not like oh gross, like random people. Like I feel like that's how Elon Musk thinks. I know people think I'm like too positive about him, but he has really fallen from grace in my mind. I still think he's an amazing business person, but on a personal level, I think he's like fallen from grace a little bit because I think he's like grossed out by people a little bit. Like, and I can tell it's probably annoying to be famous. But at the same time, I just think like actually making some effort to like share with people and to be generous outside of just like token charitable things that you probably save on tax breaks just as much as you actually like are doing good. I think is like a big difference. And yes, like I do think you could be a wealthy person and be beloved. That like a lot of people that are actually like hated in history like after like have done really nice things and have been like, been appreciated for their generosity in real time. But we've like I feel like left that so far behind now. It's like the idea that you would share wealth is like offensive.
One more topic, but I am going to save it for Wednesday. So if you're in here now, this was, I think, my favorite topic of the day, but we had so much good stuff. I want to save it for Wednesday. So you're going to have to show up 3 p.m. Wednesday to hear this question I'm going to ask George. There's a lot of meat there for him to talk about it, but I want to save it, George.
Okay. I'm trying to wonder like what it is myself. But All right. Before we go, does anyone? I want to look up the Walgreens because I want to see if. But any other questions? Wait, is it really called Walgreens Boot Alliance? Yeah, apparently that's what it's called. That's like what the company's actually called, Walgreens Boot Alliance. How does that make sense? I'm gonna have to look up more of that. Walgreens is even worse. So if you want to do this weird pharmacy play around around uh Rite Aid going out of business and candy, it looks like CVS is how you're going to do it. Whoa, what's going on there? It liked that octopus for a second. Apparently, that's how you're gonna have to do it. But I wouldn't really recommend it. And like, I would definitely I would be careful. Like, I'm gonna do one more check on QQQ. Yeah, on the 5, it's looking to lose. It's looking like it's losing a little momentum. I mean, the daily it looks great, but on the 2-hour we're losing some momentum on the QQQ. Yeah, I'm just like not. I'm not buying. I'm not buying the bull market here. I think that like I'd be careful. I keep watching QQQ net option sentiment. We'll do one more update on that and see if we have any questions. But yeah, I think QQQ is now back down to 20 in net option sentiment. So yeah, I'm looking almost, and SPY is at 15. Ooh, they're converging. Yeah, not feeling very bullish on tech after reading that. But we'll keep watching. It's been pretty volatile. But what is up with that? But you might want to, if you're profitable on some longs from today after betting that the market was going to turn, you might want to take some of those profits based on what I'm seeing.
Recently, where it just opens one way, trends the other way the rest of the day. So we'll see how it goes.
Yeah, it keeps showing like that. All right, last call for questions.
Now, just let it go. I want to see it up close.
I can't tell if it's like zooming in on the octopus or what it wants. Like, I can understand Charlie over here, but he's pretty. Charlie is the dog sleeping behind me here. Who he makes. I don't know why when he decides to make these live stream appearances, he's very inconsistent. Sometimes he's here from the start. Sometimes he's maybe like some of our viewers can't decide until the last minute if he wants to come or not.
Like when Charlie shows up or not, is it bullish or bearish for the rest of the day?
We got to start tracking. I actually, like, based on what I just saw, it does seem like Charlie coming. Like, the market started to go south around the time that Charlie walked in here. So maybe it was a warning. But it's like, yeah, these dogs, like he's a King Charles, and they're just like, for those who've never like interacted with one, they're like bred as royal dogs, and he just pretty much wants to hang out. And like, he's actually like, sometimes I'm working and he's upset. He would love for me to go and sit on the couch with him over there, and I probably will when this is over. But like, yeah, the whole breed, they're just like the happiest little dogs that pretty much just want to hang out and don't even like exercise very much. But yes, I highly recommend the breed, like especially for the city. I really like when big dogs are kept inside apartments. I feel really bad for them.
Shepherds, and they are so rambunctious. I actually have to leave my house to film these live streams because I don't want them going crazy right in the middle of the live. So, but maybe one day I'll film from there and we'll show my dogs on stream. But
yes, they're very obedient.
okay.
I'm sure you could get him to be on this on the stream wherever you wanted. All right, I don't think we're getting any more questions. Thanks for coming, everyone. We'll see you on Wednesday, hopefully. Oh, and also, I guess this is the bad sample. I just like, I think it was good for the attendance to send it out, but like, I feel bad that I'm bothering people with the emails. But oh well, that's for me to worry about. Signing off.